Hey guys, this is Liz here, the beginner investor. Happy to bring you along with my journey. This interview is the first of a series of interviews that I'll be doing with some experts and analysts to help me hone in my style of investing and figure out the next steps as I am just beginning this process. And the incredible Dave Van Knapp took about an hour out of his day to sit down and have a conversation with me about some really interesting topics. This interview covers everything from the very beginning, including what happens when a company goes public, what that means for the everyday investor like you and me, how we choose which companies to invest in, whether there are certain sources that we trust, how we gauge a company's health, and how that would affect our investment choices. We discuss the value of secondary information and making sure that the sources are accurate. As I've begun doing a lot of research, I've found that a lot of sources have wildly differing opinions on what they say is good and what they say is bad and what they say you should do and shouldn't do. And somehow you can always find one site that completely counteracts the other, which has been so much fun. That was a little sarcastic there. We talk about how dividends work. Dave discusses his strategy and how he's come to focus more on dividend growth stocks. One of the big takeaways that I will be doing in a later post is Dave encouraged me to write down my objectives for my investing to figure out exactly what I want to do. And I think that's an amazing exercise that I'm absolutely going to be sharing. Without any further ado, here is my interview with Dave Van Knapp, and I really hope you enjoy it. Please let us know if there's anything else you would like to cover in this beginning investment journey, because I know I'm learning a lot, and I hope you are too. So I'm excited to kind of chat with you since, gosh, I feel like you're the perfect person for me to talk to at the start of this journey, since you've organized a full book basically on how to begin. I'm excited to talk about first steps, and it might be, apologies if it's a little bit rudimentary, but I want to like peel back for a second and get a big picture, because to someone like me and the way that I view the economy, I think like, okay, obviously I know that there's big companies, I know that there's small companies, I know that, at some point companies decide to go public, and then it starts to get a little bit fuzzy and ambiguous. And I kind of want to take a big picture approach, why and how it works, like why a company decides to go public, what that really means for them, and what that means for the investor like you and me.
Okay, that's a great category of questions. Or take a company that we both know. Take Microsoft with Bill Gates, or Facebook with Mark Zuckerberg. When you have a good idea and start a small business based on that good idea, you may reach a scale where you realize that the idea is not only good in the small sense that you're carrying it out, but it could be of widespread popularity. Mm-hmm. Your project. In Bill Gates's case, it was software. In Zuckerberg's case, it was the Facebook idea using the internet. Mm-hmm. The internet, by the way, has opened up all kinds. We couldn't do what we're doing right now without the internet.
Absolutely.
But anyway, small companies reach the point where they need money. They're often, a small company originally is often financed right out of the pocket of the person doing it, or they get money from their parents, maybe a small bank loan. They go around all their aunts and uncles and they collect money. But at some point, that's obviously not enough. They need large sums of money. And that's where private investors come in. If you've heard the term private equity,
yeah,
that's what it refers to. It means people that are rich, doctors, people that are in the business of being private investors. I don't really watch the show Shark Tank, but that's who the panel is on Shark Tank, are rich people, right. Mark Cuban. And people come and pitch their ideas to those people. And the goal in the end, from the pitcher's idea point of view, is to get money to expand their business. And the goal from the investor's point of view is to make money when the business becomes successful. So they'll say things like, I'll give you $100,000 for 20% of your company. So that's like a value proposition for both of them. At some point, the most successful of those companies need even more money than you can get through channels like that. And that's when they talk about going public. Going public simply means that you jump through a bunch of hoops, legal hoops and regulatory hoops. But the ultimate outcome is that you sell stock to the public, not just to professional investors, but you literally sell tiny slices of your company to members of the public, to people like you and me. You end up on an exchange like the New York Stock Exchange. You end up, each slice of your company is called a share. So if you start out issuing 1 million shares, that means a person who buys 1 share now owns 1 millionth. Whereas on Shark Tank, somebody was buying 20% of the company. When you and I buy a share of Johnson & Johnson, say, we're not buying 20% of Johnson & Johnson, we're buying an infinitesimal part of it. But the idea, the concept's the same. It's just been scaled differently. When you or I buy a share of Johnson & Johnson, so we in fact own a part of everything that Johnson & Johnson owns, does, what its future is. We own all of that until we decide to get rid of it, until we decide to sell it. Does that help?
That is incredibly helpful. I listened to a lot of How I Built This. It's a podcast that NPR puts on, and it's really interesting. They interview a lot of company owners, and basically they talk through that process of when, when they get to a point where maybe it's like Angie's, I think it was Angie's Popcorn, and they got to a point where they got a huge order from Trader Joe's and went, oh no, we don't have the capital to produce this giant order of popcorn,
Right.
and okay, this makes a lot of sense. And now what I'm wondering is, so obviously from an investor then, an individual investor, when you've got all of these companies to pick through, is it more desirable to choose a well-established company who's clearly got longevity, or is it more desirable to choose? This is a loaded question because I kind of have a feeling that it's both desirable and undesirable for opposing reasons. Is it more desirable to lean towards a company that is new with potential to grow? What's the strategy? How do you pick?
Well, I'll give you my point of view, which will sound confident, and then when you talk to other people, you'll get different points of view, which will sound confident. You'll have to. Ultimately, it'll be on you. I'm a huge proponent, and we're not there yet, and I'm not suggesting you should be there yet, but yes. I'm a huge proponent at some point of pretending that you yourself actually own a little business. In your case, it'd be Liz's investing business. And some of the best books I read were written by people that made similar, I don't know if anybody puts it exactly the way I put it, but think of yourself as running a business. When you're running a successful business, you don't want to be ruled by your emotions. You don't want to be drunk when you're making important decisions. You want to run it in a business-like fashion. You want to make the best decisions you can. So eventually, at some point, if we continue down this road, either you and me or you and somebody else, I would suggest that you write down your objectives. What do you want to get out of being an investor? You talked about your parents investing, and it seems to have worked for them, although you don't know exactly how. But at some point, you're going to understand how things work, the mechanics of it, and the question will come back to you. Do you want? What do you want out of investing? Do you want getting more directly to your question? Do you want it to be like a high wire act, where you're balancing with a bunch of risky unknowns, but if it pays off, the payoff could be giant? Do you want to do something that's extremely safe? Returns are not huge, but you're not going to lose your shirt either. Or do you want to be somewhere in the middle? You'll want to write those things down. I've written them down for myself. I'd be glad to share them with you to give you an example of what I'm talking about. It doesn't have to be long, but I do suggest that it be thoughtful and that you really think, and it can change. You can write down Liz's investing strategy as of now, and 10 weeks from now, after you've had a bunch of these kinds of conversations, you might say, oh God, I don't want to do that. It was dumb. You'll learn along. When I said when I retired that I wanted to become an expert in investing, that I didn't know it at the time, but I was also going through that same process. Because the book that I wrote, which is about general investing, it was in the process of writing that book that I began to focus on a particular kind of investing that I ended up saying at that stage of my life, and given my personality and given my resource and all the rest, this seems to fit the best. So for me, it was the best balance between returns and risk, which is a balance that no matter who you talk to, that person will probably bring that up. You can take a lot of risk in the hopes of huge returns, or you can take little risk for minimal returns, but it's safe. And somewhere along the way, you'll want to decide what that is. Usually, the person's age plays into that. You're 31, I think.
Yeah.
You might have a different view of those questions than I had at age 55, and then that, which is maybe different from my view now when I'm older.
So it seems like it's highly customizable and definitely a matter of personal taste, how aggressive or how conservative someone wants to be with their choices. Is that a fair?
That's not only fair, that's insightful. Because if you were to go to a registered investment advisor, you might run into a bunch of prepackaged. Well, they'll ask you a bunch of questions. One of the very first questions: how old are you? Because the presumption is that when you're young, the way it's often put, you have plenty of time, plenty of years to make up for the mistakes that you make in the beginning. So take a lot of risk because you'll have a lot of years. And that may well be true for some people. I simply, given my personality, my approach to living, I wouldn't put that forward as a universal proposition that's always true to everybody just because you're 31 years old. I just don't think the world is like that. And I went in my own writing. And some people just write, as we were talking earlier, some people will simply write things and say, well, this is how everybody should do it. You're young. You shouldn't be doing it this way. You should be taking more risk. And I quite often will drop in a comment and say, you can't say that. You don't know the person you're talking to. You don't know where they fit on that scale. Let's just all recognize there is a spectrum, and a person's somewhere along it. And as they learn more and as they get older, they may change where they are on that spectrum, but don't put out these universality like principles like they're the Ten Commandments, because they're not.
I feel like I know for myself personally, I love taking extremely calculated and well educated risks, but like I'm the type of person that I'll go to Vegas and I will watch all of my friends play. I'll be the one swiping, their coins off the table. Like, no, you need to save that. You should slow your roll, buddy. So I agree. I know for myself, that's the idea of. Okay, so that brings me to a question. So I've found that there are resources where companies that are being publicly traded have to provide certain sorts of numbers and indicators to their company for their shareholders. And it seems like what I'm gathering is that is material that one can use to educate themselves on their investment choices. Can you explain a little bit more about that?
Yeah. Once a company has to jump through a lot of legal hoops to become publicly traded. And I don't see any value right now in saying what those all are. But the federal agency that's most involved is the SEC, Security Exchange. Sometimes it's called Security Exchange Commission. Sometimes it's called the Securities and Exchange Commission. I'm not actually sure what the real name is, but it's the SEC. They set the general legal framework for a company going public and selling shares to the public. And then the second big player is whatever exchange the company chooses to be listed on. The most well-known stock exchange in the U.S. is the New York Stock Exchange. So let's pretend that that's the exchange we're talking about. The exchanges themselves have just books full of rules and regulations that the company has to jump through. But eventually you get to what's called the IPO, and it's literally a day with a big run-up called a road show. But on that day, X number of shares, let's go back to the simple example, 1 million shares of the stock are going to be released to the public. Some of them are immediately scooped up by or are reserved for the original owners. Like, I don't know what his percentage is, but let's assume that Zuckerberg owns 30% or 20% of Facebook. His shares were never offered to the public unless he chose to go onto the New York Stock Exchange and sell them to members of the public. But all the rest of the shares simply go on sale starting that day. They ring a bell. The ticker starts to go across the bottom of the TV screen, and those shares are in play. So that's how it all starts. I feel like I've forgotten part of what your question was.
Oh, I guess I have more questions compounding on that, but we'll go back. My question was the companies provide information about, it seems like, their company's health.
Yeah, well, yeah, part of the regulations and the laws that the laws that cover publicly traded companies are reporting requirements, and those are quite strict. The general lay of the land is that companies report 4 times a year. One time a year is called their annual report. For most companies, that's when they put out a glossy booklet that looks real fancy and has a letter from the CEO in it and a letter from the CFO in it. But somewhere in it, it'll have all the required numbers. The other 3 quarters of the year, and everybody uses the same quarters, so it's at the end of March, April, May, June, July, August, September, October, November, December. Those are the 4 quarters, and everybody reports at the end of those. I'm not aware of any company that uses August as the end of a quarter. They could, I suppose, but they don't. The other 3 reports a year are not as detailed and they're not as glossy, but on all the financial information and the important news that affects the company, they are just as complete. So you have 3 quarterly reports, 1 annual report each year for the company, and that's the raw material that analysts or members of the public like you and me can turn to get the final, if you have a specific question about something. And then there are a bunch of secondary information providers that gather that stuff up, maybe add their own little twists to it, do some calculations. Like a company's report might not say our revenue grew by X% over the last 5 years. They might say it grew X% from last quarter to this quarter. But secondary providers of information gather that stuff up and do offer calculations, like they often charge for it. But then you get a graph maybe that covers, here's 20 years of this company's revenue, here's the last 10 years of their profits, and they went up most years, but then you had this horrible year and then hop right back up. You'll see things like that the company may not make as clear if you're just reading the individual reports. I personally tend to rely mostly on secondary providers that I've come to trust, that over the years I've learned they rarely get the basic numbers wrong. But if in the end you have to look something up and find out just what the hell was that number, the companies have to put it out. And they follow something called GAAP, GAAP. It stands for Generally Accepted Accounting Principles. And they all have to follow those rules. It's like rules in baseball or basketball. There's room for interpretation by the referee or by the umpire. But underneath, the rules are written out, and the company's expected to follow those rules so that you can compare. If everyone was defining the word profit in a slightly different way, then it would be hard to compare 2 companies, even if they were in the same industry, because underneath there would be different definitions working.
That makes a lot of sense. Otherwise, how could you compare someone's books to somebody else's books if they're not on the same parameters? That makes a lot of sense.
Right.
So it sounds like when you're using secondary information, who are the people that are compiling this secondary information? Like, who can you trust to supply this information?
In my own approach to investing, which can be generally labeled dividend growth investing, there is a private spreadsheet, not private, it's done by one person that has a wealth of information about this particular kind of stock, dividend growth stocks. It's called the CCC, which stands for Dividend Champions, Contenders, and Challengers. And it's on a spreadsheet. You go to a site and just download the spreadsheet into your PC, and it's got like 90 columns of information for each stock. And over the years, I've come, the person who originated that in about 2008 unfortunately passed away a couple of years ago, but his work was picked up by a much younger gentleman named Justin Law. And he, as near as I can tell, is just as careful with everything as David Fish, the originator, had been with it. So I trust that. So I kind of rank sources as don't trust at all. Then there's trust but verify.
Mm-hmm.
And then there's just a couple of sources that I say, I can try, unless I see an obvious error, I just trust what they have, and I don't feel the need to go to the company reports that we were talking about before to say, did they get this number right? Some of my sites might seem a little more old-fashioned, but on the other hand, that indicates I've been working with them for a long time, and I've learned that I never got screwed up because I write articles using the information, and somebody will come in and comment and say, this is all wrong. Where the hell did you get this? That happens to you a couple of times, like with Yahoo, and then you say, I'm just not gonna turn to them anymore, because it's not like they're offering different categories of information that the other places are. I just happen to be there that day. So you drop the ones that you learn you can't really trust, and you stick with the ones that you can.
So it seems to me that kind of a general culture when it comes to investors, they seem to be people who are very educated in the sense of not necessarily in a traditional education, but educate themselves constantly on the economy's climate, as well as, forgive me if I'm overreaching, but it may seem also like different events, both domestic and world, that might affect the economy. It seems like they would want to really educate themselves on those events and that climate to make educated decisions. Is that a fair statement?
That's a fair statement. When I said when I got out of law school, I went to work for a legal publisher, that was secondary information in the field of law. But when you asked before, well, what kind of people actually do the work? In my experience, you have new hires off the street that do some of the work. You have people that have been there for 3 or 4 years and kind of get good at it. You have people that are excellent. There's a spectrum of people. That's probably ends up being reflected in the final work product, and that's how I'm able to stratify different sites and say, trust this one, you're not so sure about that one. Probably comes back to who they've hired, how long they've been doing it. Some of these information providers go back more than 100 years.
Wow.
They've gotten really, really good at what they do, and they have, I'm sure they have standards and review processes for their employees that over time mean that the best employees rise up, and their work, and the reason they rise up is because their work is trustworthy. And other ones are found to be screw-ups that constantly get it wrong, and eventually they find another line of work. That happens in every profession.
Naturally, that just seems, I guess, I could see why it would be very important to make sure that you know that the sources that you are drawing information from are trustworthy. That's a very good cautionary note to keep in mind.
Yeah. Plus, it will save your time. If you have a trusted source that you can always go to for the same kind of, eventually you'll focus in on how you want to invest. There will be there's metrics up the wazoo in investing, but you'll learn that some are helpful to you in making decisions, and other ones just aren't. So if you find a place that supplies most of them, you'll just naturally want to go there because it'll be the quickest way to get from point A to point B in your own investing life.
Fantastic. I guess I have one more question before we wrap. Can you explain to me and this might, not too personal, but can you explain to me why you chose to focus on dividend stock?
Yes. When I was writing my general book, I wasn't focused on dividend stocks, but I had this idea that, having read a couple of years, really researched things, I ended up with this idea that stocks have personalities. You bear with me.
I was about to say, I really would love to know what you mean by that.
This term, the type A personality, type B personality. I decided that stocks were kind of like that. Some stocks were, type A is like jumpy, sense of urgency about everything, reacting to everything. What was that? At one end of the spectrum. At the other end of the spectrum are companies that are in the background of our lives doing the same thing now that they did 20, 30 years ago. They're not jumpy. They don't react too much. They're solid. They're not exciting, but they have their... So anyway, I ended up calling stocks type A's, which are just like human type A's. Type B's, which has is in the medical literature as kind of the opposite, more relaxed approach to life as a type B. And then I made up a couple, type C. I don't even remember what it was. I'd have to go look. But I ended up realizing that stocks that paid dividends seem to have their own set of personality characteristics, if you will. And it was natural to call them type D stocks, D for dividends. So I'm writing this general book and writing about all of them, but I found as I was writing the book, which took more than a year, say,
wow.
I found myself continually attracted to type D stocks because of the dividends come to you throughout the year. So some of the reward you get with dividend stocks comes to you in the form of cash arriving. In the old days, it'd be a check in the mail. Nowadays, it's a credit on your electronic account. I liked that. Most of the companies were big companies that are part of all of our lives. Before I used the example of Johnson & Johnson, and the more we talk, you'll hear me bring up Johnson & Johnson over and over again, because in some ways it's an iconic dividend growth stock. They've grown the dividend for like John F. Kennedy was president the first time they issued a dividend.
Wow.
And they've not only issued one, but raised it every year without ever skipping a year through the Vietnam War, through all the recessions, through everything. They've never skipped a year. And so I'll keep using that as an example. I found myself attracted to that. And it might have had something to do with my age. At the time, I was looking for income. I was no longer working. I'd retired. So I was looking for what might be called a paycheck replacement.
Mm-mm.
Who knows? I'm not sure what psychology was going on, but I just found myself attracted to that category of stocks. And then when I discovered the subcategory of ones that not only pay dividends but raise them each year, I was like, really? It was like finding money in the street. It was like I had no idea that those even existed.
Quick intersection. I've realized that this is a bit of question that I've wanted to know, but I forgot to ask, and then I want to return to why you decided.
Okay.
So my question is, how do they decide whether or not they're going to raise their dividends, or how do they, like every quarter, they just go, okay, we profited this much, and therefore you own 1,000,000% of the company, you get 1/1,000,000th of our profit? Or how does it? Okay.
That's basically it. When a company, before you asked a series of questions about how companies get started. And we talked about how do they finance themselves. They have to go to somebody with more money than they have and basically beg for it, tell them their story, and the people with the money decide that they'll either take the risk and offer some money in exchange for part of the company, or they won't. And they say, go on. We have better opportunities. Okay, now fast forward, say, 30 years. And that's a pretty good, well-chosen time frame. Now that same company with its original entrepreneur and founders is doing really, really well. They no longer need to go beg for money. They make money themselves. And some companies, I would say many of the best among them, make so much money that they not only don't need to ask other people to loan them money or to give them money in exchange for part of the company. They don't need all the money they make to fulfill all their plans for growth, to maintain all their equipment, to pay all their employees. They make more money than that. And so they say, what are we going to do with it? What a lot of companies do is say, well, let's start issuing dividends to our shareholders. And you have to remember, in many cases, the companies are owned by people that own lots of shares. So when they declare a dividend, dividends are paid per share. So if, say, 30 years from now, Facebook is there, and Mark Zuckerberg, who's now older, still owning a third of the company, when his company, if Facebook were to declare a dividend, and creating this huge pool of money to be distributed to all the shareholders, Zuckerberg would get his 20%. 20% of that pile would be going right to him because he would own that many shares.
This makes sense. I had wondered before, I was thinking, how would that benefit? Why would the company be rewarding their shareholders, not realizing that the executives and many of the people who are high up in the company are shareholders? Therefore, it is good. What is good for the goose is good for the gander. Got it.
Yep.
Okay. All right.
Why would they make the decision to distribute it to shareholders? But over time, some companies reach that decision, and then it becomes kind of part of the culture. After you've been doing it long enough, your shareholders come to expect it.
Mm-mm.
That is at the 5 to 10 to 15 year mark. I would say when a company's been issuing a dividend for 5 years, it's not really part of the culture. It just means they have money left over a few years and they decide to start a dividend. They're not committed to it. But after 10 years, after 15 years, and now a company like Johnson & Johnson with a 55-year streak of raising the dividend each year, not only issuing it, but raising it, that's really part of their culture. It would take, almost an asteroid hitting Johnson & Johnson headquarters to cause them to change enough to say, let's skip this year.
Yeah.
That would be giant, giant, giant news. One other thing that's interesting to me is I'm old enough now to have lived through and to have seen some companies that used to be type A's, namely the earliest tech companies. So we're talking Microsoft, Cisco, things that are now thought of almost as stodgy old technology companies. At one time, they were not stodgy old technology companies. They were doing things that nobody knew whether they were going to work. They didn't know anything about laptops or FaceTime or anything like that. But they are now dividend growth companies.
Wow.
They've gone through the stage of their life where they were begging for money. They went through the stage of their life where their original ideas worked out. They had good enough management to know how to branch and expand and still stay in the sweet spot where things were successful and not make too many mistakes where they made acquisitions, say, that lost money. And now they're in a place where they're so solid that they're thought of the provider of choice for many things is Microsoft. The provider of choice for many things, and this gets more personal, I guess, I'm sitting here with my iPhone, is Apple. Mm-hmm. Apple, believe it or not, is now a dividend growth stock company. And so I've seen companies, so like when I was using Zuckerberg and Facebook as an example of one that might be, we have better examples that within the recent past, by recent, I'd say within the last 10 years, have become the kind of companies that I'm interested in. So Apple, I own a lot of Apple stock, and when I decided that they were committed to their dividend growth, I never took a chance on Apple just as a growth stock. But when they started to do the dividend bit, they have all this cash. They have like the most cash of any company, publicly traded company in the world, I think. Like $150 billion or something. They got plenty of money to pay a dividend.
Yeah.
So anyway, I've seen that transition. And in your lifetime, your investing lifetime, you will see the same transition for some companies now that you would shake your head and say, they'll never pay a dividend. Look at all the things they're inventing. They need money to invent stuff. It'll happen.
So thank you for explaining that. And I guess that leads right back into what made you decide that dividend stocks were the most of interest for your investing style.
I decided that, remember before I said treat your investing like a business and start out, the first thing you do, and I've consulted with businesses and helped them do this, the first thing you do is you come up with a mission statement, or you try to. Just thinking about it is worth the time. And as you work on your mission statement, you start to think about, what do I want to be? So you end up with a list of objectives. So in my own investing, I decided that one of my objectives was to invest mostly in companies that are not all that risky, to invest in companies that pay me. That's what dividends are. They pay me. I don't have to sell a share to get money out of my investment. They'll send some of their profits to me every year. That appealed to me. I was recently retired and thinking in terms of replacing the income that I formerly got from a paycheck into what might be called passive income. I'm not a big fan of that phrase, but in a sense, it's passive in the sense that once I make the decision, the active decision to buy that company's shares, the receipt of the money becomes passive. Every quarter they declare a dividend, it just shows up in my account. They usually have more type B personalities than type A personalities. I consider dividend stocks to be a subset of type B stocks, going back to my personality trait thing that I was talking about before. Anyway, there are probably a couple other reasons that I could dig up over time, but that was basically it. It was a package of characteristics that just appealed to me. And one last thing I'll say about dividend stocks, because they're paying you, and this was a big change for me. You tend to grow up, if you turn on CNBC and watch her for an hour, everything's about price. Second to second changes in price. That's what they highlight on the screen when they have their narrators in the foreground, the background, or at the bottom of the screen. They're running tapes by with price changes, and they're using flashing lights.
Yeah.
And if price is down for the day, they use an alarming red color. Even if it's down 1 penny. A stock that sells $100 a share is down 1 penny. The color turns red. And I think we all grow up thinking, when you're listening to a radio station or a market wrap up just in the national news, they'll say, well, the Dow today went up 200 points and the NASDAQ went sideways and the S&P went up a little bit. It's all about price. It's all about price. Nobody ever comes out with a headline that says Johnson & Johnson just raised their dividend 7.5% from last year. They never do. What I found with dividend growth investing was it drew my attention away from this fixation and kind of fear sells. And so things going down attract a lot more attention than things going up. And it tends to motivate you. It can motivate many people. Their fight response kicks in. So they flee. Things are going down. I better get out of the market. They sell stuff. And there's all kinds of research that's been done that shows that investors do, in fact, do that. And as a result, they underperform the market itself because they're out of the market. When the market turns around and goes back in, they're scared. I grew up with parents that came through the Great Depression. My mother never got over the Great Depression. Wow. Stocks scared her entire life. My father got over it maybe when he was in his 40s and began investing in the stock market. I don't think my mother wanted him to do that with their money. Those things last. And more recently, you're old enough to certainly to know about it, but I don't know if it affected you. The Great Recession in 2008, 2009. If you're not watching that stuff so much and so intently, you're less likely to be pulled by it.
I see.
Like, I'll go, people, my friends, neighborhoods, somebody will have a Christmas party or something, and people know that I write about stocks and investing. A couple people follow me. And so just over a drink, they'll say, what'd the market do today? Usually I don't know.
I love that.
I'm so detached from, because I'm investing and focusing on income. I can tell you how much my income went up from one year to the next, but if you ask me what the market did, I literally got to go look it up. I just don't follow the prices. So I'm like insulated from the fear and the fight-flight response that constantly following price, because the market goes up and down. Every trade is at a different number from the prior trade.
Right.
Dividends aren't like that. I'll get the same dividend from Johnson & Johnson the next time they pay one as I got the last quarter, until the quarter comes where they raise it once a year, and then it'll stay the same for 4 quarters, and they'll raise it, and it'll stay the same for 4 quarters, and they'll raise it. That's real. When you chart that out, I'll send you a link to a chart that looks like a staircase. Goes up and to the right, never goes down, and it's like, cool. And that if your focus is more on that, you're less likely to be scared by, or not even know that Johnson & Johnson had another talcum powder incident and their price fell 2% or so. You won't care. They're Johnson & Johnson. They'll still pay their dividend. They'll still raise it the next time they raise it, whatever their schedule is, once a year. So anyway, just a basic thing there that kind of snuck in. You probably picked up on it. Dividends generally are paid by American companies, generally paid once a quarter, and then raised once a year. So you get 4 payments in a row. One amount goes up with the 5th payment, and then it's that payment for 40, and that follows the annual calendar. And they usually tend to most companies tend to declare their dividends around the time that they're doing these quarterly reports that we talked about before.
From what I've gathered, this is really supporting the decision that for me, since my long-term strategy is to basically sock away monthly, just keep socking away until basically I get closer to, retirement and enjoying, like you said, a paycheck replacement, enjoying the passive, I know that's a term you don't like, but enjoying the income from the dividends. And since I'm kind of playing the long game, I was already planning to really dive into dividend stocks as my focus, but this has been so helpful for you to shed light and explain from your expertise and explain from your own experience why that decision was right for you. Really hopeful that we can continue this conversation because it's been incredibly helpful for me, and I know that I'm not the only person who has these questions, and just your generosity with your time and your expertise is not only a gift to me, but also anybody else who might be watching and learning from this. So thank you, thank you, thank you.